Now, tell us more. This is quite interesting. Affordable housing is something that you folks have always spoken of. How much money is coming in? What is the equity ratio? How much are you putting in? How much comes in from the JV partners? And when do you get things off the ground?
So we're very excited with this partnership with IFC. They're committed to affordable housing in India. So the total transaction that IFC has committed is about $73 million. That's about 556 crores. The first phase of investment would be about 300 crores into two projects, one in Cochin and the other one in Bangalore. Total area of these two projects put together would be close to about 4.4 million square feet. About 165 crores gets invested by IFC into the Cochin one, and about 135 will get invested in the Bangalore project. These are two great projects focused on affordable housing and with good margins. So we're very excited, and we hope that this will be a long-term relationship with IFC.
Okay, so just to get the numbers right, it is 76 million. And how much will have to come in from Puravankara?
So the first project in Cochin is a land already owned by Puravankara. So there they are buying in equity. The second in Bangalore is a land that we are buying together jointly. We've already invested our equity. The balance will be invested by IFC.
Ashish, you know, while affordable housing is one segment, the one big segment which has seen a huge number of sales, especially during the pandemic, is the entire luxury housing segment. Can you give us a sense in terms of whether or not you benefited from that in the past couple of months, and why not invest within that segment if it is showing traction at this point?
So if I go back the last 6 months, both segments, the luxury as well as the affordable housing, has done extremely well for us. So if you see last quarter's numbers, we did close to 0.85 million square foot of sales, new sales. And that was equally contributed by the affordable segment and the luxury segment. When I say affordable, it's not really low-cost housing. So these are affordable in terms of ticket size and unit sizes, but they are still premium projects in terms of the finishes, amenities, etc. So both have done equally well over the last 6 months.
Okay, so give us some numbers of both these segments in the past six months, affordable housing as well as luxury housing. How much have you seen in terms of growth, and how much are you anticipating from both these segments going forward?
So in terms of the last 6 months, the total sales that we did was close to about 1.5, 1.6 million square feet. About 55% of that was contributed by our Provident brand, which is focused on premium affordable housing, and the balance was luxury housing. We've seen sales across ready-to-move-in projects, under construction, as well as the new launches that we've done over the last 3 to 4 months. So there's equal amount of traction. The sense is that customers and fence sitters through the pandemic and lockdown somewhere realized the importance of owning a home, more importantly a new home with modern amenities that have been designed well, and that's the traction that we've been experiencing. And in fact, if you compare the numbers to last year, the last 6 months we've done even better.
Yeah, sure, absolutely. All this work from home, stay at home, definitely made you think of a home, right? So, just to dwell a little further on that point, now Q2 was a strong quarter for you, Ashish. There was revival happening on both sales value and volumes. Give us some color on the recovery in Q3 and what you're expecting in Q4. Is it going to get even better? I mean, some sense on how inventory levels are moving. Are those levels coming down? And what you're looking at in terms of the area that's going to be launched, fresh launches, and just how the sales momentum is shaping up.
I strongly believe that Q3 and Q4 should be equal to or much better than the last 6 months, especially when we add the new launches that we've planned. Between both the brands, we have about 10 to 12 million square foot of launches planned over the next 12 months. The broad breakup would be about close to 3.5, 4 million square foot of new launches under the Puravankara brand, and about 7 odd million square foot under the Provident brand. This is across the cities of Cochin, Bangalore, Chennai, Pune, and Mumbai. So we're quite excited. We are confident basis what we've experienced over the last 6 months, a strong sales, strong traction, like I said, across ready to move in, under construction, and the newly launched projects. If you see, our ready to move in fact, has come down significantly from what we started the year out with.
Okay, so sure, I mean, there will be improvement if you're looking at it on a sequential basis. That's a given because we were in absolute lockdowns in the, for the first 4 months of the year. But if you compare the volumes that you're doing now vis-a-vis where you were last year, help us understand that. Are you at equal levels of, let's say, November, December last year? Are you better than that?
We are, in fact, a tad bit better than what we did last year. So even if you look at the last 6 months, we have done more sales than we did in the 6 months the previous year.
Ashish, did you cut prices at all in any of your projects in the past 6 months in order to bulk up in terms of volume sales?
Not at all. In fact, in the last quarter, we took the prices up depending on the project, the location, and the brand. The prices were increased by about 2 to 5%. Just to absorb some of the increase in costs that we experienced over the last 6 months. So there has been no reduction in prices, in fact increases.
Oh, okay. So an increase in prices by 2 to 5%. Just give us a sense in terms of where exactly do you stand when it comes to your debt, because you are getting money into the company now, over 500 odd crores. Debt stands, and correct me if I'm wrong, it's over 2,600 odd crores. Give us a sense in terms of what the plan is to reduce it. Do you need to reduce it? What your working capital needs are?
So currently, in terms of debt, by the way of this transaction, the debt should come down by, so the first investment is about 300 crores from IFC. That would help us get the debt down by about 150 crores. But having said that, because of the strong traction that we've seen in our ready to move in inventory as well, I think put that together, there should easily be a reduction of about 450 to 500 crores probably over the next 12 months. Having said that, in terms of new debt, I don't foresee a significant increase, because if you see the way we've been selling even our new launches, or if you even take the launches that we've done over the last 2 to 3 years, we've changed the selling model where we are selling a higher volume upfront in the first 2 to 3 quarters, therefore relying very little on construction finance or increase of debt.